I think it's most important to understand that this is not gold going up. It's mostly currencies everywhere depreciating against gold, not just the dollar, but all currencies. And I don't know, it's not only a normal bull market, which I see very clearly, but it's also a monetary system reset, which I see very clearly. And when you see an environment where foreign governments and central banks hold more gold than U.S. treasuries, it's a sign that they trust gold more than they do the dollar and our debt. This is a big deal. This is a monetary reset. This is a reshuffling of the deck. I think people need to understand that. It's crazy that this isn't all over the mainstream, that this isn't spoken about. It's shocking to me, and it makes my disdain for the legacy media grow by the day.
Therefore, today, we will investigate an argument that is simple in its mechanics, but profound in its potential repercussions. The norms of engagement for a market that has been dominated by leverage and derivatives for a long time are being altered as large, sophisticated pools of capital are increasingly acquiring physical silver. The immediate consequence is not merely an increase in nominal pricing. It is an altered equilibrium between the paper claims that have governed the market for decades and the physical inventory that has been allotted. The nucleus of risk that underpins the remainder of this discourse is that imbalance. The sustained and concentrated appetite for physical metal is indicated by recent flows into exchange vehicles and vaults, as well as large private transactions that are being taken into secure custody rather than left as paper exposure. The pool of deliverable bars that historically satisfied daily settlement and hedging requirements contracts is diminished when major institutional actors acquire metal and maintain it in segregated or off-exchange custody. This contraction, if it persists or accelerates, significantly increases the likelihood that any significant attempt to satisfy paper claims with physical delivery will encounter a supply shortage. This is the precise circumstance that can transform a market correction into a disorderly price event. Miles Franklin and renowned bullion dealer Andy Schectman will detail these points: the inflows into ETFs and vaults, warnings and perspectives about delivery risk, and the macro backdrop that is encouraging sovereigns and large funds to invest in physical metal over the next few minutes. If you find this analysis to be beneficial, please consider liking the video, subscribing, and leaving your comments in the section below. We are grateful for your assistance and trust that you will find the video to be enjoyable.
I think it's most important to understand that this is not gold going up. It's mostly currencies everywhere depreciating against gold, not just the dollar, but all currencies. And I don't know, it's not only a normal bull market, which I see very clearly, but it's also a monetary system reset, which I see very clearly. And when you see an environment where foreign governments and central banks hold more gold than U.S. treasuries, it's a sign that they trust gold more than they do the dollar and our debt. This is a big deal. This is a monetary reset. This is a reshuffling of the deck. I think people need to understand that. It's crazy that this isn't all over the mainstream, that this isn't spoken about. It's shocking to me, and it makes my disdain for the legacy media grow by the day. Look, our massive debt means that we will almost certainly rely on money printing to pay it back, which erodes the value of the dollar. Foreign holders of our treasuries and our dollars do not want inflated dollars, so they too are shifting into gold. And it's because of the credibility, the liquidity, the physical security. This is what has shifted gold's bull run from $1,700 to $3,500 an ounce in just the last 3 years. And then at the same time, you got momentum building with guys like Putin and Xi and Modi, who are openly urging trade in local currencies, which again are laying the groundwork for a world less dependent on the dollar, done again. And that's, this is what it is. It's not so much gold, it's the dollar. It's everything Gold is the barometer by which we measure everything else. And when you have a treasury that is projecting well north of 22 to 25 trillion in debt in the next several years, with our foreign creditors who have supported our lifestyle backing away, I mean, I don't know, isn't it always been the Fed that stepped in and with more money printing, risking inflation? I don't think this is panic. This is a sober reality. Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record, speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. And it wouldn't surprise me. And then they revalue it. The higher the price of gold goes, only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. You know, this will probably, I doubt people would get this, maybe people watching your show, but if you bought, what do you think was the best performing asset if you bought the day Nixon closed the gold window on August 15th, 1971? Well, obviously I'm asking the wrong crowd, but number one was gold. Number two was the S&P 500. Number three was the Dow Jones. Number four was silver. And this is including reinvesting every dividend for compounding gains, which no one ever does. Investors never do that. But if you had invested every single dividend for the past 54 years, gold is still outpaced the Dow and the S&P. Silver came in just behind those at number 4, but it goes to show the old adage that Wall Street wants us to believe that because there's no yield on gold, you should have known it. It's actually a joke.
Andy's more detailed explanation underscores that the increase in gold is not merely a commodity movement, but rather a price signal regarding currencies and confidence. In his view, a nominal all-time high in gold is more indicative of currency depreciation across a broad cross-section of fiat than an isolated bull market in one bullion asset. This preference signals a structural reallocation of reserve and portfolio capital when sovereigns in large pools of capital prefer gold to treasuries or bank deposits. This preference can accelerate flows into related assets, particularly silver, either as a perceived relative value or as a complementary store of physical wealth. The background for the stockpiling behavior we previously discussed is that macro squeeze. The liquid exchange-eligible inventory available to meet paper claims decreases when big money begins to perceive metal as a secure repository and physically acquires it, whether through ETFs that convert shares to bars, segregated storage programs, or direct vault placement. A concentrated withdrawal of deliverable metal results in a disparity in a market where derivative positions and short exposures remain substantial. After this, the market transitions from a traditional supply-demand narrative to one that also encompasses logistics, delivery regulations, and institutional incentives. Who is responsible for the bars? What is the location of their storage? What are the conditions under which claimants may request them?
Valuations, don't measure it against the dollar, measure it against gold, and you'll see that in terms of gold, things are getting cheaper. And I expect that the price of gold only goes higher because, as Michael Oliver, who you have on your show all the time, he's talking about a real massive capital rotation from Western mainstream legacy investment stocks, bonds, etc., into precious metals. He says this happens but once only every 50 years. Doing a little bit of reading this weekend, found it very interesting that before Scott Bessent became the U.S. Treasury, he wrote this. I'm going to read it from his January 2024 Key Square Capital Management letter. And then I want you to think about where we are right now today and his role in all of this. We believe that this, and again, he was writing this for a letter. He was a capital management letter that he was working for in 2024. We believe that this inappropriately easy policy, monetary policy they're talking about, inflated the dot-com equity bubble. our best case is that a re-elected Donald Trump will want to create an economic Lollapalooza and engineer what he will likely call the greatest 4 years in American history. In this scenario, here's the important part. The greatest risk factor, in our opinion, would be a sudden rise in long end rates. I find it interesting. I think this explains why he's so much into gold. And, this is where we're going. This is the path that we are heading on. I also found it interesting that Besantis also advocated for a comprehensive independent review of the Federal Reserve. He called for scrutiny of the entire operation, its monetary policy, its regulation, its staffing, its communications, blah, blah, blah. He argues that the Fed has strayed beyond its mandate and needs to regain credibility as a non-political institution. He said that the Fed should relinquish its banking supervision duties and limit economic intervention, particularly unwarranted bond purchases outside of crises. But this aligns with President Trump's effort to increase influence over the Fed. So if that happens, you look at Stephen Mirren being put in and Trump's attempt to sever the independence, if you will. Isn't that exactly what Goldman Sachs was warning about? That the political control harms its credibility, increases inflation, undermines its trust. Bang, gold goes to 5,000. So it's happening right now. I mean, you can see it as being undermined. And so, I think that one should expect gold to go much higher in the face of a dollar going much lower and the Federal Reserve losing independence, as Goldman Sachs has so eloquently spoke of, about all of the gold being delivered into COMEX. Not all of it is leaving. A lot of it is. So far, there's been just shy, 3,626 contracts. I read this over the weekend, so I don't know how many more have stood for delivery. That's $1,305,360,000 worth of gold in just the first few days of the September contract. At the same time, there was 10,599 silver contracts delivered. That is worth $2,225,790,000. So, I mean, every single month there's billions and billions and billions coming in, and before it's all said and done, it'll even be more. People wonder ways by which they hold the price down with all of these deliveries. One of the ways is through GLD and SLV. In SLV right now, the short position, which is controlled, by the way, SLV by custodian, is BlackRock and JP Morgan. The short position in SLV increased by almost 20% to 53.97 million shares. And as Ed Steer says in his own words, this is fraudulent beyond deception, as there is no physical silver backing any of it, as the SLV prospectus requires. Crazy, to be honest with you. It truly is. You look at a period of time where all of this metal is coming in, where deficit spending has gone so far out of control that the Fed is really losing control of interest rates, in my opinion. And the U.S. has issued over $200 billion of bonds in 5 weeks. Then again, we're reaching a point where investors don't want to buy U.S. government debt at current yields. And let's talk about what's happening around the world. In the UK, 30-year bonds have broken above 5.7%. for the first time since 1998. But the crazy thing about that, think about what Trump wants to do, right? Remember last time the Fed lowered rates by 100 basis points, what happened to the 10-year? It went up by 100 basis points. Well, the Bank of England has cut rates 5 times this year and ended up with rates at a 27-year high. How the hell does that happen? So the market is literally rejecting interest rate cuts due to deficit spending and inflation. So when the Fed cuts rates in 2 weeks and blames a weak labor market, are we next? Is this going to happen to us? You got the U.S. unemployment rate for 16 to 24-year-old kids at 10%. And not to mention all the revisions we have seen, the labor market is weakening into rising inflation. Here we come, stagflation. And for the first time since 1996, central bank gold holdings surpassed those of U.S. Treasuries. This is the ramifications. And we saw that potential earlier this week when the central bank announced more and more countries are starting to do this. When we saw earlier this week, El Salvador's central bank revealed that it bought gold for the first time in 30 years. It bought 14,000 troy ounces, $50 million worth. It's interesting that it used the proceeds from its Bitcoin reserves to fund the purchase, something that it's the opposite of a lot of the talk we hear around here. Speaking of Fed independence, sorry, I'm just going through some notes that I have here just to kind of touch what I thought was relevant this year or this week. Trump has signaled he wants to appoint someone who is more inclined to lower interest rates, with a point which he has, been very adamant about. Again, Fed losing independence. Goldman Sachs says the market gets one whiff of that.
The short squeeze in silver would not be the result of retail investors alone. Rather, it would be the result of a combination of larger forces, including steady inflows into funds that demand physical metal, large purchases that remove bars from the deliverable pool, and a trigger that compels counterparties to either post margin or deliver silver. A large holder demanding delivery, margin calls in the futures market, or an abrupt price move could all serve as triggers. A squeeze would likely result in an outsized nonlinear advance upward, as the supply of high-quality delivery bars is restricted in the short term. However, there are genuine exceptions to this situation. The paper markets continue to offer liquidity and can maintain prices at a low level for an extended period than their fundamentals would indicate. Mining and recycling can eventually increase supply if prices remain elevated, while large actors can bridge gaps by sourcing metal globally. In addition, the likelihood of an unchecked spike can be mitigated by regulators and exchanges through margin modifications or other policy measures. These opposing forces indicate that a silver price of $700 is feasible. However, it is contingent upon certain conditions. It is contingent upon the market's ability to source metal in a timely manner, the degree of concentration of demand, and the urgency of the delivery. Additionally, the market structure is indispensable. Synthetic exposure can obscure genuine supply pressures, and physical ownership is not equivalent across ETFs, futures, and custodial programs. In contrast, the system is tightened by the removal of metal from circulation through visible conversions into allocated bars. When investors transition from paper claims to specific physical units, delivery itself is significantly impacted by frictions such as bar standards, vault logistics, and custodian willingness. Finally, silver is not only an investment metal but also an industrial one, with a consistent tangible use that is supported by the demand for electronics, solar, and manufacturing. In certain regions, geopolitical maneuvers such as trade settlement shifts or central bank reserve strategies can exacerbate shortages and disrupt flows. The lesson for investors is to comprehend the evolving risks, rather than to presume a straight line to $700. The weight of price is now equal to that of counterparty exposure, delivery certainty, and custody decisions. In this environment, the strategy should be guided by a clear thesis for holding silver, appropriate storage, and position sizing. If you found this analysis to be beneficial, please consider liking the video, subscribing for additional analysis, and leaving a comment indicating your preference for the most probable scenario: a gradual revaluation, a delivery-driven squeeze, or a protracted period of muted volatility. I appreciate your attention.